Next guest says now is the perfect time to snap up some cheap stocks, especially small caps. Joining us now is Brian Smoluch, the principal and portfolio manager at Hood River Capital Management. Brian, great to have you with us.
Thanks, Melissa. Good to see you.
At what point do you think a potential Russian invasion of Ukraine is an impact? I mean, it's obviously impacting the market, but at what point does it prevent you from deploying new capital?
Well, I actually don't think it does at this point. As far as companies that we're looking at in the portfolio, any impact to the earnings forecast that we're looking at next 12 to 24 months is minimal. I think what's a lot more important is the inflation and rate outlook for the vast majority of the portfolio.
And so for the holdings that you have, Brian, they're not insulated from inflation. So how do you factor that in? And are you assuming that the Fed has a handle on inflation, will be able to control it? Because that seems to be a major risk, particularly to small caps.
It definitely is. The market's pricing in right now around 125, 150 basis points worth of tightening. If you look at high yield spreads, which is a good proxy for people's attitudes toward the small cap market, those are okay. They're around 140 basis points. So the way we're thinking about it is we just want to attack each name aggressively on valuation, which is what we do anyway. And then we want to use the downdraft here to buy the companies where we think they're inefficiently priced based on that earnings power and the fact that the street estimates are too low. We want to be part of good companies, good management teams that are going to make or beat estimates at good valuations. And the valuation part is what protects you in bad markets like this.
So in the past couple of weeks, in the past month or so, when the markets have had a volatile time, Brian, and we're really coping with first, inflation fears and now also with Russia invasion fears, are there positions you've added to, or are there new positions you've taken on?
Yeah, we're pretty active. We've added to Celsius, we've added to Lovesac, we've added to Chart Industries. All of those companies we think are going to make or beat estimates for the next 6 to 18 months. The valuations are all attractive. Celsius is actually extraordinary growth. It's growing around 230% right now. The street has 65% growth this year. I think it's be closer to 100%. And I expect the earnings forecast for 2023 to be more like 2022. So you see a big pull into demand. And I think they're going to deliver on earnings no matter what happens with rates and with Ukraine, for example. Lovesac is a couch company, essentially, and they've added this technology that embeds speakers in the couch that doubles the average selling value of the system when they sell it to a customer, which gives a lot of flexibility with how they deliver numbers throughout the course of this year. The street's estimating around 25%. I think they can easily exceed that based on this new product.
Are these two companies immune or less impacted by supply chain issues?
So Celsius, the big concern there is can availability. And I think they've locked in cans, aluminum cans, for all of this year, and they can deliver on the growth numbers that I was discussing earlier. Lovesac has done a good job diversifying their supply chain and building up inventory. So I think they can easily hit the growth numbers based on supply chains. It's nothing new for these companies. They've been building it up. The margin hit is already built in to both of those companies' street estimates. And I expect the margins to trough either this quarter or next quarter based on supply chain issues that you were just referencing.